they didn't see it coming. The biggest opportunities are where no one is looking.
Why would two of the world's biggest investment firms spend billions buying Burger King and KFC in Japan right now? In March 2026, Goldman Sachs' private equity arm acquired Burger King's Japan operations for 70 billion yen. A year earlier, Carlyle Group paid 95 billion yen for KFC Japan. These are major capital deployments by firms managing hundreds of billions in assets globally. But here's what's strange. Japan's fast food market already has McDonald's with over 3,000 locations. Domestic chain MOS Burger has 1,300 stores. So why would Wall Street commit billions to compete against entrenched players in what looks like a saturated market? The answer reveals where the real money is hiding in Asia right now. What if the fast food market that looks crowded is actually undervalued in major ways? Carlyle paid approximately $600 million for KFC Japan in 2024. Goldman Sachs acquired Burger King Japan and now operates hundreds of locations across the country. These aren't experimental ventures or small side bets. These are serious billion-dollar commitments to a market most international investors completely ignored for years. So what did these mega firms see that everyone else missed? The answer starts with demographics that are reshaping Japan in profound ways. Single-person households are rising dramatically. Dual-income families are becoming the norm. More women are entering the workforce and staying there. These fundamental shifts in family structure create demand for quick, convenient meals. Fast food doesn't require cooking, cleanup, or family coordination. For single people and busy couples, fast food becomes a lifestyle necessity rather than an occasional indulgence. At the same time, inflation is making fast food more attractive as an affordable option. Restaurant meals have become expensive in Japan, but fast food remains accessible. The combination of demographic and economic factors creates a hidden tailwind that most investors completely missed. But here's where the real insight emerges. Most people look at Japan's fast food landscape and immediately conclude the market is locked up. McDonald's dominates with decades of history. MOS Burger has deep cultural roots. The market looks saturated. There's no room for growth. Playing it safe means avoiding Japan entirely. But Carlyle and Goldman saw something completely different. They saw opportunity where others saw saturation. They looked at a market with only 2 or 3 major players and asked a different question. What if we could be the third option? What if we could capture the millions of consumers who want alternatives to McDonald's but aren't satisfied with the existing choices? This is where understanding competitive dynamics becomes absolutely crucial. In America, the burger category is heavily crowded. McDonald's, Wendy's, Burger King, In-N-Out, Five Guys, Shake Shack. Consumers have dozens of options. They vote with their feet. A brand needs to be exceptional to win. But Japan? Japan has virtually no burger competition outside McDonald's. The market is concentrated in one dominant player. There's no second major burger chain offering serious alternatives. That creates what investors call a market gap, a consumer desire that isn't being fulfilled. Goldman's strategy is straightforward and proven. Grow Burger King to 600 locations by 2028. That's from current baseline. Take share from McDonald's one location at a time. Build a second option for burger-hungry consumers. The same playbook that works in saturated markets works even better in concentrated markets. In fact, it works better because the incumbent isn't used to serious competition. McDonald's has been dominant so long it might not react as aggressively as competitors in more competitive markets. Carlyle's KFC strategy follows identical logic and reasoning. KFC isn't new to the Japanese market, but the brand has never received the investment or attention it deserves. Carlyle is aggressively pouring capital into expansion, modernizing stores, upgrading supply chains. The brand has significant potential for major expansion with proper capital allocation and management focus. Carlyle has both of these things. The firm knows how to scale food businesses successfully from their global experience.
The real story goes deeper than fast food strategy. Japan's private equity market is experiencing a renaissance that most Western investors don't fully appreciate. Goldman Sachs is planning to invest roughly $5 billion in mid-cap Japanese companies over the next decade. It's a fundamental strategic bet that Japan is where returns are. The country has proven management teams and real cash flows, but valuations are dramatically lower than equivalent businesses in the United States or Europe. A Burger King location in Manhattan might trade at 5 times cash flow. An equivalent Tokyo location trades at similar profit potential, but at a quarter of the valuation. That's the valuation gap Goldman and Carlyle want to exploit. But here's what most people don't understand about this strategy. It's not just about financial returns. It's about reshaping entire markets. When Goldman scales Burger King, that's introducing new competition into a market that's stagnated. That creates better consumer choice. That pressure on McDonald's drives innovation. The same logic applies to every market Goldman and Carlyle are entering. They're catalysts for market evolution in a country that needs it. The other silent factor is operational expertise and labor efficiency gains. Japan's companies are often run by long-tenured management who've never worked elsewhere or traveled internationally. That creates significant operational inefficiency throughout the organization. Goldman and Carlyle bring global expertise from operating restaurants across dozens of countries. They apply those lessons directly to Japanese businesses, and suddenly, those businesses become dramatically more profitable and operationally efficient. Looking at this from the investor perspective, the thesis is genuinely compelling on multiple levels and dimensions. Japan's currency weakened significantly in recent years. That makes assets cheaper for dollar-denominated investors buying in. Japan's interest rates remain near zero. That makes real assets more attractive than bond returns. Japan's demographics create tailwinds in convenience and efficiency categories. The government is actively trying to attract foreign investment. All these factors align to create what seasoned investors call a window of opportunity. That window doesn't stay open forever. Eventually, valuations will normalize, returns will compress, the money will move elsewhere. So the firms moving now are racing to deploy capital before the window closes permanently. For Burger King and KFC specifically, the next 3 to 5 years are absolutely critical to their success. If Goldman successfully scales Burger King to 600 locations, the chain becomes a serious national player challenging McDonald's dominance in the country. Carlyle's KFC can follow a similar trajectory with aggressive expansion and capital investment. These aren't speculative bets on unproven concepts. They're based on proven business models that work globally. The only question is execution and capital deployment. And that's where Goldman and Carlyle have genuine competitive advantages that other investors don't possess. They have unlimited capital. They have expertise from operating hundreds of restaurants globally. They have management networks spanning the industry. And they're moving decisively to capture it before the broader market catches on. By the time other investors realize what's happening in Japan, the best assets will already be owned by the firms that moved first. Like this video and subscribe if you want to understand how global finance really works. And in the comments, tell us if you think Goldman and Carlyle will successfully scale these fast food chains.